Hey, good morning, Carrie. There she is.
How are you?
I'm great.
Sorry I missed last Thursday.
You missed last Thursday. That was terrible. Yeah. Oh my goodness.
I've been, my mom had surgery. I've been caring for her, and then I
Oh,
came home and I just overslept. So
yeah. No problem. Hope your mom's doing okay.
yeah, she's getting better.
Let's see here. So I'm going to try to come up with the PowerPoint. Looks like we're up to chapter 14, huh?
14. Okay. I was so confused on the last homework.
Oh, really?
Homework assignment. Yeah, I think that was chapter 12 or
13?
something. With the whole purchasing or what is it?
LIFO, FIFO?
No, it was the one
No.
before that.
Okay. Yeah, we can review that as well.
Okay.
Now let's see here. I gotta go back in.
Adjustments for merchandising business.
Yeah, that's what we're gonna do right now.
Okay.
Get all the buttons up here. All right. I'm having a tough time waking up here. I don't know what's going on. I know what it is. I haven't had my soda.
What soda? First thing in the morning, huh?
Yeah.
My girlfriend used to do that. She'd have a Coke for breakfast.
Always. Oops,
Having
oops.
tea.
Oh, come on now. What's wrong with this thing? Come here. Get up there. Modules. Chapter 14. This thing is not showing me anything for chapter 14. Hold on. Oh, here we go. Chapter 14. It's kind of buried in the middle here. Come on now. Okay, Carrie, I think we're ready to begin. Share the screen. And if you still want to go over another chapter, you can share a screen back if you need to.
Okay.
Okay. Yeah, these three chapters, 13, 14, 15, they kind of bring us back full circle to where we got involved with debits and credits for the first time.
Mhm.
All right. Adjustments for merchandising business. We've already been through most of this, and they're just throwing a couple little hooks at us here. Prepare an adjustment for a merchandise inventory using the periodic inventory system. Yeah, just reviewing what we do in a periodic. You debit purchases, you credit AP, you sell it, debit AR, credit sales.
Can you go back to that screen? Just a
Yeah.
sec.
You know, your basic journal entry.
So
Under the periodic, you're debiting everything to purchases, not to inventory.
okay.
And we're gonna have the worksheet, the same worksheet we had before, that 10-column worksheet, you remember?
Yeah.
And we're gonna go through it. And they're throwing in a couple new adjustments. Adjustment for merchandise inventory, okay?
Mm-hmm.
We've not seen this one before. You know the expression out with the old, in with the new?
Yeah,
That's what we're doing here. We have to write two separate journal entries. We have to write a journal entry to credit the old inventory to get it down to 0, and then in with a debit on the new inventory balance to bring that back, to bring that into the system. Okay? So let me demonstrate it over here. What they're saying here is during the year, merchandise inventory is never changed during the year under the periodic. You take an inventory at the end of the year, and that account inventory never gets touched for the rest of the year, because you're not recording the cost of goods sold or inventory when you sell something.
okay.
So now it's the end of the year. We're taking our physical inventory, and it's time to put up the new balance of merchandise inventory. So a two-step adjustment is needed to update the balance of the merchandise inventory. So here we go. Out with the old. The beginning inventory is removed by crediting merchandise inventory, okay?
Mhm.
And you debit your famous income summary. Remember that account, the clearing account for all the closings?
Yep.
So that's simple enough, I think. You get rid of the old first, out with the old, in with the new, by this time debiting the ending inventory, by debiting merchandise inventory and crediting, excuse me, income summary. All right. Note that the debit and credit adjustments made to income summary are extended to the adjusted trial balance columns. Yes, we need to bring it all the way over there, because that's going to be part of the calculation on the income statement.
It's the ending inventory. Okay, sorry, can you go back a sec? Is entered by debiting merchandise.
That's how we get the new inventory up there.
Okay,
You could argue, why don't we just make an adjustment for $4,000?
right.
Well, we could, but the reason we don't is we want to bring over both the beginning and ending inventory over to the income statement and the adjusted trial balance,
Mhm.
because they're going to be used in the income statement. We start with the beginning inventory plus purchases, less ending inventory.
Okay.
So there's not too much to this. Out with the old, in with the new.
Yeah.
Students get confused with it, though. They overthink it, I believe. Steps 3 through 5, and emerging likely that customers will return. So they're just showing you an entry that's made when customers return things to us. Returned inventory is not debited to the merchandise inventory account. Again, we're going to capture this at the end of the year. Now, I am not even going to teach this portion of the chapter. This deals with estimated returns.
Mhm.
And we as a faculty thought this was kind of a weird thing to have in here. And we're just going to skip it. What it boils down to is some companies estimate in advance what their sales returns and allowances are. And
Uh-huh.
we're not going to worry about that. You won't see it on the test either, okay?
Okay.
Trust me on that. You
Okay.
trust me?
I trust you.
Revenues minus sales returns and allowances, huh? We're not worried about the customer refunds payable. Yeah, we don't do anything with the estimated. Wherever you see these estimated line items, we're skipping those, okay?
Okay.
So they're just showing you the updated T accounts, the updated ledger. They're bringing all this stuff up to date. Calculation of cost of goods sold. Here we go now. Oops. Oh, for the love of Cecil. Okay, here's our trial balance. Here is the out with the old. You see that right there, the 23,000 coming out?
Yep.
And there's the 27,000 going in.
Yep.
Notice we brought both balances over to the adjusted trial balance.
Okay.
And we're also going to bring them over to the income statement, I believe, in a moment. And they're showing you some of the journal entries that we're learning here. Out with the old again, I can't say that enough. Debit the income summary, credit merchandise inventory. In with the new, debit merchandise inventory, credit income summary. And we're not worried about these estimated refunds or returns, okay? Now here we go. Oh, so sorry. Oh, for Pete's sake, got butterfingers. There we go. You can read that, right?
Yeah.
Okay. This is our longer income statement. And we did this a little bit in the prior chapters. We have sales minus sales returns and allowances, minus sales discounts,
Yeah.
minus credit card fees, right? To get us to what we're going to call net sales, okay?
Yeah.
Then we want to get the gross profit, which is net sales minus cost of goods sold.
Right.
But look at the convoluted process we have to understand now to get the cost of goods sold number. It's the beginning inventory plus your purchases plus freight equals cost of goods equals goods available for sale. Let me repeat that. Your beginning inventory plus the goods purchased, including freight, gives you goods available for sale. That's the most you could have sold, right?
Right. So, but I know you said you're not dealing with it, but when they put in the estimated returns inventory, that's not actual, right? It's estimated, right?
It's an estimated number, yeah.
But they're still giving you a hard number of 25,000.
Yes. In the world of accounting, there are a certain number of estimated numbers. There can be
Okay.
quite a few.
But you're
Yeah.
saying that you wouldn't do this, or?
We've never seen anybody in the real world who does this, is what we were saying as a faculty.
Okay, got it.
Yeah. And then when we realized it wasn't showing up on the test banks, we kind of blew it off. Maybe next semester we'll do it for the incoming group. But we thought it was more of a distraction than anything else.
Okay, so if you were doing this form, that would be eliminated. That one line would
Yes.
be eliminated.
Yes.
And it would be 23,000 instead of 25,000.
That is correct.
Okay.
Same thing up here. This
That's
would
what
be
I'm saying.
23. Okay.
Yeah. Yeah.
So our beginning inventory is 23. We purchased all of this stuff here. So there's what's available.
Yeah.
At the end of the month, we take a physical inventory and we subtract the inventory from the available, and that gives us the cost of goods sold.
Okay.
The good cost of goods available. That's the most we could have sold. That's what we had at the beginning of the month, plus what we brought in during the month. Now it's the end of the month. That $104,200 number, Carrie, that cost either is going to be in the cost of goods sold or the ending inventory. It can only be in one of two places, okay?
Okay.
So at the end of the month, we take a physical inventory and we learn that we have $27,000 still sitting on the floor, which tells us we sold $74,200 worth of goods at cost.
Got it.
Okay.
Okay.
Unearned revenue. Well, we've been over unearned revenue a couple times, right? Unearned revenue, cash received in advance before delivering a product or performing a service, and it's recorded as a liability on the balance sheet because the company owes the customer the product or service. They don't owe the money. They owe them the concert series or the subscription to the magazines they paid in advance. And they give us an example. Brown County Playhouse sells season tickets. Tickets sell for $10 a play, 5 plays. So that's 50 times 1,000, right? 50,000 tickets, okay? Or rather 5,000 tickets at $10 a ticket. They debit cash and they credit unearned ticket revenue. And I think you recall this pretty well, right, Gary?
Yeah.
Yeah, we got the money in advance, but we haven't done anything to earn it yet.
Right,
So we
so wouldn't that be
must,
accounts receivable?
no, 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 no. It's not accounts receivable because we got money in advance.
Oh.
We announced that next month we're gonna put on 5 plays
Mhm.
and we received $50,000 in advance ticket money. That's a liability because we haven't done any of the plays yet.
Got it.
So we owe these people 5 performances of My Fair Lady or whatever it is, okay?
Mhm, mhm.
Adjustment for unearned revenue. Following production of the 3rd show, financial statements are to be prepared. So they did 3 of the shows. They did do $30,000 worth of performances.
Mhm.
Now you debit the liability account, which is called unearned ticket revenue, and you
Mhm.
credit regular revenue. Oh, excuse me. Little frog in the throat. You look confused. Are you thinking about this one, Carrie?
Um, no, it makes sense. Yeah, so debit unearned revenue
Liability, yep.
and credit ticket revenue.
Yep, now we
Okay.
can put it on, now we earn the money. Now it
Right,
goes on the income statement.
got it.
Prior to that, it was on the balance sheet. And they're just showing you here in terms of the T accounts, what's going on.
Mhm.
Here, they're just showing you some of the new accounts that we supposedly were just introduced to. Some of them we're ignoring, others we're not. Prepare a worksheet for the merchandising business. And here are our steps. Prepare the trial balance. Columns 1 and 2, trial
Mhm.
balance.
Mhm.
Columns 3 and 4, the adjustments.
Mhm.
Columns 5 and 6, the adjusted trial balance.
Mhm.
7 and 8, you do the income statement. 9 and 10, you do the balance sheet. And that's exactly what we did earlier. In fact, on one of your tests, they gave you a bunch of questions, didn't they? What's in columns 6 and 7? Remember that?
Right, right, yeah.
So let's look at these adjusting entries. Most of these we've been over many times. So A and B, this is the out with the old, in with the new. A physical count showed that the merchandise inventory costing $45,000, 600 is on hand on the 31st. Okay?
Yeah.
So we're gonna have to do a little out with the old, in with the new here. I don't see them giving us a physical count. Yeah, they're not giving us the beginning number. They're gonna have to get that. Okay, we're not worried about the estimated sales. You remember this, right? With the prepaid supplies,
Mhm.
you have an asset, a prepaid supply, and you debit supplies, which is an asset, and you credit
Mhm.
cash. And
Mhm.
then when you use the asset, that's when you debit the related expense, supplies expense and credit prepaid supplies. I'm assuming you're good on that.
Yeah,
And the same thing with the prepaid insurance.
right.
When you buy the insurance, by definition, it's an asset. It's
Mhm.
only when you start using it in the future that you start expensing it. Depreciation expense, I think we got that pretty easy. And wages earned but not paid. That's our famous wage accrual. You work the last 3
Right,
days of the month.
got
And
it.
then Sunflower Cycle publishes a cycling magazine. Subscribers pay in advance unearned subscription revenues as of the 31st is 1,000. So they're telling you that at the end of the month, they had 1,000 sitting there in unearned revenues. Can you read the numbers, Carrie, or need to?
Yeah, I can read them.
Okay. Well, let's take a quick look. Look at the merchandise inventory. Turns out 52,000 was the beginning.
Got it.
A, out with the old.
Well, that's the estimated, right? Oh, is
No,
that
no, 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 no.
okay,
This is not estimated.
okay,
These are hard numbers.
got
So
it.
you credit the old inventory and you're
Mhm.
gonna debit the income summary for 52,000.
Okay,
Then they told us over here that the new inventory count is 45,600.
mhm.
So now we debit 45,600 and credit the income summary, okay? We're ignoring the estimated, and there's your supplies being reduced by the amount of usage, prepaid. We should be good, very good with depreciation expense. And take a look at the unearned revenue. They had $3,000 sitting in unearned revenue at the end of the month. And then they're telling us here that subscribers pay in advance, unearned revenues as of the end of the year were now 1,000. So we have that $2,000 adjustment. We
Mhm.
debit unearned revenue and we credit subscription revenue. Okay. Is there anything there that seems unwieldy to you right now, or?
I don't know, it's just so, yeah, I mean, it just takes time to figure out what goes where.
Yeah,
Right.
we and we went over a lot of these already in the first
Yeah.
4 weeks, a week of the course, and this is something of a review,
I
as
still
well
have
as
to
in,
think it through though, so.
yeah, the only thing new they're introducing in this chapter that we're going to worry about is the out with the old and with the new
Mhm.
journal entry.
Okay.
I challenge you. Can you read those numbers?
No,
How about now?
yeah,
Okay. So they're just showing you the first 6 columns of the worksheet, and we know how to do this. We have merchandise inventory. We had a balance of $52,000.
yep.
We credited it to make it zero, right?
Mhm.
52,000. And then we debited the new balance, bringing the new balance over to the adjusted trial balance, okay?
Mhm.
And then let's find the unearned revenue, because that's always a fun one. The unearned revenue, they said there was 1,000 left. So we had to debit unearned revenue and credit income summary for the number
No,
there. Not
no,
income summary. Where's the revenues?
subscription revenue, right?
Yes, I'm trying to find.
It's just at the bottom, right there.
There we go. Thankfully, I had it. It was blocked here.
Yeah,
So I think we're pretty good on the worksheet. You're not going to have to put a worksheet together,
good.
but you're going to have to be able to piecemeal it.
Mhm.
Journalize adjusting entries. Well, for heaven's sake, we know what the journal entries look like. Oops. Playing with the zoom in. There's our journal entries. The only one that's new is the merchandise inventory one, the out with the old and with the new stuff, okay?
Mhm.
Let me do this.
Okay, wait, so you had 52,000 and then and then okay, you had 52,000 at the beginning, right?
Yep, yep.
Then at the end of the year, okay, is this a whole year period?
A whole year's gone by.
Okay, then you have 45,600 at the end of
Right.
the, so you started with 52 and now you have 45,600,
That is
right?
correct.
Okay,
Yeah, the 52,000 was what we counted at the end of 2020.
mhm,
Now we're coming to the end of 2021. We counted and there's 45,600.
okay,
So the inventory went down a little bit. We shipped more than we purchased.
okay.
All right.
Mhm.
Adjusting journal entries under the perpetual inventory system. Under the perpetual system, the merchandise inventory, the estimated stuff, cost of goods sold are continually updated. So let me move this over here and get out of my way. So we're worried about inventory purchases and sales. Now, this is an important grid to look at, Carrie, okay?
Mhm.
The reason is this shows you the difference in some detail between the periodic system and the perpetual, okay?
Mhm.
The perpetual system, we never ever debit or credit merchandise inventory except at the very end of the year.
Mhm.
Under the perpetual, we're doing it every time we sell something and every time we buy something.
Mhm.
Here's a little tip here. You notice at the top of where it says periodic system here, Carrie, it says
Mhm.
purchases for 800 or whatever that number is.
Yeah.
Under the periodic system, we call them purchases. Under the perpetual inventory system, we call them merchandise inventory. Wherever you see purchase, you can just change it to merchandise inventory. Purchase returns and allowances under the periodic merchandise inventory. Just a little tip for keeping the two methods clear. So under the periodic system, we're debiting a cost called purchases. Under the perpetual, we're debiting an inventory account called merchandise inventory. So the only difference is purchases become merchandise inventory.
Okay.
Take a look at the important one here. We sold something for $800 for $400 that cost us $300. Under the periodic system, when we go to this, when someone comes to our store, all we do is debit accounts receivable or cash and
Mhm.
credit sales. We do nothing with the cost of goods sold. Look what happens on the perpetual side. You have the same entry for the sale portion, a debit to AR and a credit to sales. But look what they're doing with that cost of goods sold number. They're recording the cost of goods sold and recording the reduction of the merchandise inventory. On the purchase, on the perpetual side, you always know exactly how much you have out there. Okay?
Mhm.
Something was, we returned something. We returned something. That's easy. We debit accounts payable and we credit purchase returns and allowances. What did we say about purchases and the perpetual? Purchases become merchandise inventory under the perpetual system.
Mhm.
Okay, and these are the two. Okay, yeah, we'll go
So,
through this.
okay, so you're comparing these two systems, but like the perpetual would only be done, I'm sorry, the periodic would only be done at the end of the year, say.
Yes, yes.
So,
The cost of goods sold in inventory, yeah, at the end of the year.
okay, and so are you comparing this, like, so is this the perpetual system at the end of the year?
No, the perpetual system means just that. They're
Right,
doing this, they're adjusting the cost of goods sold and merchandise inventory every day.
right, but I'm just saying that when you're comparing these two charts, are you showing that like this is what it looks like at the end of the year at the same time?
This is what's happening during the year, not so much the end of the year.
So this
During
is,
the year, you have sales every day, right? Hopefully.
yeah,
So those are the sales. That entry is the same for either method. It's just that in the cost of goods sold, you have to, in the perpetual method, you must account for the cost of goods sold and the reduction of the inventory at cost.
okay. Okay,
Return goods. Now
and
a
you're
customer return.
saying
Go
that,
ahead.
now today in today's world, it's more often the perpetual system, right?
Oh, absolutely, absolutely. I went into substitute for Professor Woyak, Dr. Woyak now. She's a Dr. Woyak. Very qualified, I guess you'd say. And I went into her classroom to substitute. And the first thing she told me was she does not even teach the periodic system at all
Right.
because it's all, but I think you have to teach it because that's how you learn how to come up with the cost of goods sold and the calculations. So just a little difference between some of the teachers, I guess. Customer returns something to us. Notice the entry is the same as
Mhm.
far as the sales go, the sales portion.
Mhm.
But again, we have to record the cost of goods sold in the inventory. This time, someone is returning to us $40 worth of inventory, right?
Mhm.
So the inventory has to go up. The goods were good enough to sell again, and we credit cost of goods sold. We're reversing part of the original cost from before. Make sense?
Yeah, I guess. So, so, okay. So sales returns and allowances, $50, right?
Yep,
Someone returned something that, okay, so it cost $50, but your cost was $40.
that's correct.
Okay,
That $40 of inventory has to be put back into the inventory, right?
right.
So we're doing that with the debit to inventory, and we're reducing cost of goods sold because we debited cost of goods sold in the first place.
Mhm.
In other words, we're basically just reversing this entry you see here. The only difference is you never debit sales. You
Okay,
debit the offsetting account,
all right,
contra, okay?
yeah.
A customer returns something sold in a prior period. We're not gonna worry about that. And then the only other entry, the only other entry we're gonna worry about is the one we've been talking about since the beginning. Adjustment for merchandise inventory. You go out with the old and in with the new. Out with the old, in with the new. On the perpetual side, you don't have to worry about that because you always know supposedly what is in your inventory.
Right.
So under the perpetual system, you might take an inventory at the end of the year, right?
Mhm.
You still might do it. And you run your perpetual reports, and the perpetual system says you have $1 million of inventory. But you only counted 999,000.
Mhm.
So you have a loss there that they simply put in an account called cost of goods sold, inventory short and over.
So yeah, yeah, that's where you would account for like theft or something, for example, right?
Exactly. Theft or mistake made somewhere in accounting or a
Yeah.
transaction that got in twice. Could be a lot of different things. Yeah. That's where you catch it.
Okay.
Now, what many companies do, and we did it for years, during the year, even though we knew we had a perpetual, we counted every day. We went out and we counted maybe 3 or 4 items at the most. We picked out the high dollar items and a couple of small dollar items and went out and counted them. It might take 20 minutes, a half hour, and then
Mhm.
the people would come back to the office and
Mhm.
compare it to the perpetual. And if they were in agreement, we felt good and we could just keep going. If you do that every day for a whole year, you pretty much counted the whole inventory in
Yeah.
terms of the dollar value. And then, of course, the physical inventory at the end of the year gives you comfort.
So
Okay.
would you count the same items every day or it's different items?
Different items.
Okay.
They were called a cycle count. In
Okay.
other words, you have an inventory, say $1 million. There might be 30 items out of 1,000 that account for 1/3 of that million. You know what I mean?
Uh-huh.
The high ticket items. So
Yeah.
you'd always count a couple of those, and then you'd count a couple in the middle, and then a couple of cheap ones.
Got it.
You want to cover enough dollars, but you want to make sure that the little guys are being handled as well.
Mhm.
Again, we're getting into the world of the estimates, which we're not going to worry about. Hey, here we go. You know what we call it? We call it shrinkage. Shrinkage. Perpetual inventory system does not eliminate the need for taking physical inventories. Perpetual records must be compared with the physical inventory to discover and correct any errors or losses from theft, breakage, or spoilage. And the word they use in accounting is inventory shrinkage. It
Mhm.
shrank. It wasn't there. It was there, and now it's not.
Yeah.
And that's a simple journal entry where you debit or credit inventory. You debit or credit an account called cost of goods sold, inventory short and over. And there was nothing more frustrating than to go to the trouble of taking an inventory where you actually shut the business down for
Mhm.
3 days or so,
Yeah.
and you get all these counts done, and you verify that the counts are correct. You're very comfortable. You counted okay, and then it doesn't match the perpetual records. Oh, that is really frustrating.
It is. Yeah.
In this case, they're only off $130, so that sounds pretty good to me.
Mhm.
And that, that's the end of our chapter, by the way.
Okay.
So not too much here. Like I said, don't worry about the estimated returns and refunds. The inventory short and over, that's a new one. The out with the old, in with the new expression, that's new. Otherwise, it's just kind of a review, huh?
Yeah, I mean, it's the same principle, just repeats, you know, so.
Yeah. And then the next chapter, we continue along with this worksheet a little bit, and they give us some metrics to work with. We'll do some interstatement analysis of the income statement, the balance sheet, and equity. So we're
So
getting there. We've only got we've only got 1, 2, 4 more chapters, huh?
So next chapter is 15.
15, and then we go back to 7, 8, 9.
7, 8, 9. Okay, got it.
So we only got 4 more chapters. Today is August, what, the 20th today? November. Yeah. Wow, we're running out of time pretty quick, huh?
So yeah, when does this class end? December, right?
Yeah, first week of December is the final exam.
Okay.
Yeah. So we might be getting a little bit ahead. Let me just take a quick look if I can, if it's available. Yeah, here we go. I'm looking for, we just did 13, right? Yeah, so this one, so
No,
we're just,
14. We were in 14.
we just did 14?
Yeah.
Okay, so we're about a week ahead. We got ahead of ourselves a little bit.
Okay. So,
15.
all right. So then, I don't think I'm going to be here on Thursday. So,
Okay,
so if we could just do next Tuesday.
okay, well, we'll dedicate the next video to you then, Carrie. You can look at it at your leisure.
Okay.
All right,
So what are you covering on Thursday?
Thursday, chapter 15.
Okay.
Chapter 15.
All right.
And that puts us way ahead. You know something, Carrie? I may not even do it, a lecture, because we're ahead.
Right.
Chapter 15, your summary is not due until August 30th.
October, yeah.
So I don't think I'm even going to do a lecture on
Thursday.
Thursday.
Well, maybe you should just do Tuesday lectures.
Yeah. That's probably the way it was supposed to be all the time, huh?
Yeah.
Yeah. So all this time we've been working hard twice a week.
Right.
We only had to do it once a week.
Okay.
So yeah, I think that's right. We're going to be on Tuesday. We're going to be on a Tuesday schedule now.
Okay,
And
that sounds good.
And Thursdays become a vacation day. Okay.
There you go. Yeah.
All right. Well, you take care of everything. All right.
Okay. And then if I have questions, specific questions, you do the tutoring also, right?
Yeah, you got the tutoring schedule.
Yeah.
And you can always text me with a question if you got something, quick.
Yeah. Yeah. Because I was, the last homework I was, where you have to fill in all the forms. I was just completely confused and I couldn't find it in the chapter specifics. And so
Okay.
I didn't finish.
Yeah, you can always get me in tutoring, and you can share the screen what you're looking at, and
Okay.
we can get through it. Okay.
Okay. Sounds good.
All right. We'll see you later, Carrie.
All right. Thank you.
Bye-bye.
Bye.